Hello, everybody. My name is Yaman, and I provide daily updates on Tesla, markets, and technology. Let's get started right away. Markets are generally up today. Nasdaq is up 0.8%. Oil is up 2% to $63 per barrel. Yield curve is pretty much unchanged. Let's read the daily article. S&P 500 Nasdaq advanced ahead of Fed remarks. S&P 500 and Nasdaq edged higher on Wednesday following a blip in a steady rally as investors awaited fresh clues on the interest rate trajectory. With the US government shutdown delaying the release of key economic reports, traders are likely to lean heavily on commentary from Federal Reserve officials to guide their positioning. Euphoria around AI has helped equities brush off concerns around the shutdown so far, but gold's historic break above $4,000 an ounce underscores growing appetite for a hedge against policy risks and shaky macro backdrop. Gold is becoming the safe harbor for the dollar used to be, said Matthew Tuttle, CEO of Tuttle Capital Management. Dow came under pressure as Goldman Sachs and JP Morgan fell 1.6% and 1.2% respectively. Moderna rose 3%. BofA Global Research upgraded the U.S. healthcare sector to overweight from underweight. Remarks from Dallas Fed President Lori Logan, Chicago Fed President Austin Goolsbee, and Fed Governor Michael Barr, and Minneapolis Fed President Neil Kashkari are on deck. Minutes from Fed's September meeting are also due at 2 p.m. Eastern. The rally in stocks has also drawn support from expectations of a dovish Fed going forward, as a batch of alternative indicators pointed to a softening labor market. Quote, I think the Fed is absolutely flying blind because of the data blackout, but I don't know how much it really matters for the October meeting, said Chris Hodge, chief economist of US at Natixis. Global investment firm Carlyle estimated on Tuesday that US employers added just 17,000 jobs in September. We're going to dig into that a little bit. That was well below the 54,000 gain economists polled by Reuters had expected in the official non-farm payrolls report, which was due late last week, but was delayed in the government shutdown. Among stocks, Fair Isaac Corp fell 2.5% after credit bureau Equifax said it plans to offer cheaper mortgage credit scores. U.S. listed shares of gold miners rose with Newmont and Gold Fields up 1.3 and 2.4% respectively. Dow rose 7% after multiple brokerages raised their price target on the stock. Freeport McMoran rose 5% after Citigroup upgraded mining companies' rating to buy from neutral. Joby Aviation declined 11% after electric air taxi maker on Tuesday priced a $514 million share sale at 11% discount to its last closing price. Let's move on to Tesla. Tesla reveals cheaper Model Y and Model 3 standard versions. The two less expensive Tesla models are expected to boost sales in a post-EV tax credit world. Tesla finally revealed a stripped-down version of its Model Y, dubbed the Standard, and in a surprise move announced the Model 3 Standard as well. The two cars are now available for order on Tesla's US website. The Model Y Standard is rear-wheel drive, will start at $39,990 and an estimated range of 321 miles with the standard 18-inch wheels. The Model 3 Standard comes in even cheaper at $36,990 and has the same range. While the Model Y Standard is available for November-December delivery, the Model 3 Standard arrives a little later with December-January delivery range. Appearance-wise, the standard trim omits the front and rear light bars on the Model Y and comes in only three colors: stealth gray, white, and diamond black. The only interior color available is black. Tesla stock gained more than 5% on Monday after the EV maker posted gifts on Sunday of a spinning company logo with the date 10/7 and what appeared to be car headlights shining through smoke. Shares pulled back nearly 4% on Tuesday following the update to Tesla's website. Inside, both standard trims feature the same 15.4-inch infotainment screen as the more expensive models. However, there is no second row screen, the ambient lighting has been removed, and cheaper cloth seating inserts surround the vegan leather per Tesla's website. Interestingly, Tesla removed the AM/FM radio tuners from the standard trim, and the standard models can only perform traffic-aware cruise control. Tesla's version of adaptive cruise control and are unable to perform auto steer functions like autopilot and FSD. It's also likely that Tesla has run costs from its batteries and electric motors to make the vehicles cheaper. The Model Y and Model 3 standard versions come after the federal EV tax credit expired in the US on September 30th. CEO Elon Musk said the company's second quarter earnings call that the cheaper Model Y would come out after the tax credit expires. Tesla said following Q2 earnings that the first builds of a more affordable model occurred in June, with volume production planned for the second half of 2025. Tesla's release of these cheaper vehicles is expected to help grow volume for the automaker, which has seen sales dip in recent quarters, although Q3 sales jumped as buyers bought EVs ahead of the tax credit expiration. Last quarter, the CFO said he expected a pull forward of sales in Q3 because of the tax credit expiration, and the numbers back up that claim. The question is, how many people pulled forward their orders? Feel free to drop your guess in the comments. I have a number in mind, but I've seen varying estimates on this. Let's move on to macro. In lieu of government data, investment firm Carlyle reports subdued U.S. hiring. Carlyle Group released its own measure of U.S. economic data on Tuesday, including a sharply lower estimate for September jobs growth despite rising economic output, to a market left wanting official releases because of the government shutdown. The global investment firm estimated that U.S. employers added just 17,000 jobs last month, far below the 54,000 expected in the non-farm payrolls report, which had been scheduled for release last week. The firm's internal indicators showed GDP growth running at 2.7% annualized pace in September, a 3.8% drop in energy prices, and 3.3% prices for services excluding shelter. If you look closely at implied payroll and employment growth, you'd think that this was an economy of cusp of recession or that has already fallen into recession. Jason Thomas, head of global research and investment strategy at Carlyle, told Reuters. Quote, we've seen a big rebound in household consumption and ongoing business spending fueled by the AI boom. It's a really interesting time to see the disconnect between employment and broader measures of economic health. With official statistics delayed, investors are increasingly turning to alternative sources for real-time insights, and data-rich firms are positioning themselves as stopgap providers of economic intelligence. The U.S. government shutdown has entered its seventh day and is showing little sign of resolution. Private data providers are seeing a sharp uptick in demand. Research website bigdata.com saw a 175% surge in usage after the shutdown, its founder Armanda Gonzalez said in an interview. When the official data channels go dark, investors are going to continue going for alternatives, Gonzalez said. Carlyle drew data from its portfolio of 277 companies, which employ just under 730,000 people and 694 real estate investments. Thomas said the boom in spending in AI was also out of step with the rest of the economy. All the oxygen is being sucked by AI, Thomas said, pointing to a booming demand for X-rays and other key semiconductor components. This growth is uncorrelated, he added. It reflects a secular technological shock. Other private data released in recent days also point to weak hiring. Job search firm Challenger Great Christmas said last week planned hiring in September hit its lowest since 2009, when the industry was reeling from its financial crisis. Goldman Sachs strategist says no stock market bubble yet. The stock market may look like it's on a high, but according to Goldman Sachs, it hasn't crossed the bubble territory. There are elements of investor behavior and market pricing currently that rhyme with previous bubbles. Peter Oppenheimer, Goldman's chief global equity strategist, wrote in a new note. However, we see key differences. The report pointed to several similarities between today's market and past speculative booms. Valuations are climbing, market leadership is narrowing, and capital intensity is increasing. Additionally, the emergence of vendor financing in the AI space is echoing dynamics seen in the late 1990s tech bubble. Oppenheimer pointed out that bubbles typically occur when the combined market value of companies linked to a new technology far exceeds the cash flows they can realistically generate. That disconnect hasn't happened yet, he said. The AI boom so far has been led by a group of tech giants, including NVIDIA, Microsoft, and Google, with little sign of the explosive competition that typically fuels market excess. Indeed, big tech's dominance has ballooned. The 5 largest US tech companies are now worth more than the combined markets of Euro Stoxx 50, the UK, India, Japan, and Canada. Meanwhile, the 10 biggest US stocks, 8 of which are tied to tech, account for nearly a quarter of the entire global equity market at roughly $25 trillion. That level of concentration could raise bubble comparisons and has even prompted investors to start questioning whether all of this is rational or classic signs of an unsustainable bubble. But unlike those earlier episodes, Oppenheimer argues that today's rally has been supported by strong fundamentals rather than irrational speculation about future growth. The report also noted the biggest winners, such as leading AI and cloud companies, have unusually strong balance sheets, providing a cushion that many dot-com firms lacked. Still, Oppenheimer isn't dismissing concerns outright. Valuations in the tech sector are becoming stretched, the note said, citing a range of metrics including PE ratios, PEG ratios, price to book versus return on equity, and dividend discount models. However, those valuations have not yet reached the extreme levels seen in the past bubbles, such as the dot-com era or the late stages of the 2020-2021 tech surge. For now, the rally appears to be on firmer ground, though not without risks. We're going to skip this one. SoftBank to buy ABB's robot business for $5.4 billion in a push to merge AI and robotics. SoftBank Group has agreed to buy the robotics business of Swiss engineering group ABB in a $5.4 billion deal as the Japanese investor forges ahead with a strategy to fuse robotics and AI. The acquisition announced on Wednesday is the latest by founder and CEO Masayoshi Son to establish SoftBank as a core player in the development of AI. SoftBank pushed into humanoid robotics a decade ago with its Pepper robot, but later scaled back its ambitions. Its recent investments in the sector include Berkshire Grey and AutoStore, and it also led a $40 billion funding round in ChatGPT maker OpenAI, and in March bought chip design company Ampere for $6.5 billion. SoftBank's next frontier is physical AI, Son said in a statement. The deal means ABB has abandoned its original decision to spin off and separately list the industrial automation business, which competes with Japan's Fanuc and Yaskawa, as well as Germany's KUKA in making factory robots. The decision is the first major move under ABB CEO Morten Weirdoort, who took charge last year and follows years of struggling sales and falling profitability for the robots business. An ABB robotic arm, ABB's robotic division, which employs 7,000 people, generated sales of $2.3 billion last year, equivalent to 7% of ABB's total revenues. But the company saw limited crossover with the rest of its business, which focuses primarily on electrification and automation. ABB announced to shareholders in April its decision to spin off robotics, but decided to sell instead because the SoftBank deal provided money immediately, Weirot told Reuters. Following the deal's announcement, Switzerland Zürcher Kantonalbank said it had expected valuation of slightly less than $4 billion for the robotics business under the planned spinoff. ABB shares opened 2% higher in Zurich, while SoftBank shares did not move significantly, ending the day down 2%. Expected to close mid to late 2026, will generate cash proceeds of roughly $5.3 billion. Okay. On Apple, hypertension notifications available today on Apple Watch. Starting today, Apple Watch introduces the groundbreaking hypertension notifications featured in Canada, which can alert users if signs of chronic high blood pressure or hypertension are detected. Hypertension is the leading modifiable risk factor for heart attack, stroke, and kidney disease, and impacts approximately 1.3 billion adults globally. It's frequently undiagnosed because it often has no symptoms. Many people do not see a doctor regularly, and even during a clinical visit, it can be easily missed with a single measurement. Hypertension notifications on Apple Watch use data from the optical heart sensor to analyze how a user's blood vessels respond to the beats of the heart. The algorithm works passively in the background, reviewing data over 30-day periods, and will notify users if it detects consistent signs of hypertension. These notifications provide users with valuable insights into their health as it relates to this widespread condition simply by wearing their Apple Watch, so they can begin making potentially life-saving behavioral changes or start treatment to reduce their risk of serious long-term health events. Users can set up hypertension notifications in the Health app on the iPhone. That's pretty cool. That's really cool. There's some more details here. You can pause and read it if you want. NVIDIA's Huang says he's surprised AMD offered OpenAI 10% of the company in clever deal. NVIDIA CEO Jensen Huang said Wednesday that he's surprised AMD offered 10% of itself to OpenAI as part of a multi-billion-dollar partnership announced earlier this week. Quote, "It's imaginative, it's unique and surprising, considering they were so excited about their next generation product," Huang said in an interview with CNBC's Squawk Box. "I'm surprised that they would give away 10% of the company before they even built it. And so, anyhow, it's clever, I guess." OpenAI and AMD reached a deal on Monday, with OpenAI committing to purchase 6 gigawatts worth of chips over multiple years, including its forthcoming MI450 series. As part of the agreement, OpenAI will receive warrants for up to 160 million AMD shares, with vesting milestones based on deployment volume and AMD's share price. If OpenAI exercises the full warrant, the company could acquire roughly 10% ownership in AMD. AMD shares have soared since the announcement and were up 5% Wednesday, rising a staggering 35% so far this week. NVIDIA shares were nearly 3% higher on Wednesday following Huang's comments. The deal challenges NVIDIA's dominance in the AI chip industry, a market where AMD has sought to catch up, alongside cloud providers which are developing their own chips. NVIDIA late last month announced it planned to invest up to $100 billion in OpenAI over the next decade. OpenAI agreed to build and deploy NVIDIA systems that require 10 gigawatts of power, which Huang said at the time of the announcement is equal to between 4 million and 5 million GPUs. Huang said the investment is very different from OpenAI's deal with AMD, that it allows NVIDIA to sell directly to ChatGPT creator. NVIDIA's investment in OpenAI has underscored concerns about the circular nature of some AI futures infrastructure deals. Asked how OpenAI will fund the deal with NVIDIA, Huang said they don't have the money yet. They're going to have to raise that money, though, through, first of all, their revenues, which is growing exponentially, equity, or debt, Huang said. They gave us the opportunity to invest alongside other investors when the time comes. Huang added that after NVIDIA previously invested in OpenAI, he only regret is that we didn't invest more. Huang also confirmed NVIDIA's involvement in xAI's latest funding round, in which Elon Musk's AI startup is reportedly seeking to raise about $20 billion, according to Bloomberg. NVIDIA is set to invest $2 billion, the outlet reported, citing people familiar with the matter. Huang said he's super excited about the finance opportunity, adding that he wishes he could give Musk more money. "Almost everything that Elon's part of, you really want to be part of as well," Huang said. NVIDIA has also backed AI data center operator CoreWeave, which Huang said he considers one of several terrific investments made by the company recently. Quote, "They're really special companies and they're part of our ecosystem, building out the AI infrastructure for the world," Huang said. And on that note, thank you very much, everybody, and I will chat with you all next time. Take care.